Hello, I'm Jen Kohls of Richardson Capital Management, and I'm with Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update for October 2025. So, October brought us negative headlines regarding the government shutdown, tariff uncertainty, and inflation. And yet, the public markets advanced for the sixth consecutive month. Dan, to what do we attribute that strong market performance?
Sure, Jen. So the first point you talked about was the government shutdown. I think investors widely anticipated the government would be shut down, maybe not for the full month of October, but we've seen numerous government shutdowns in the past. And for the most part, what we've learned is financial markets do just fine and economic growth remains resilient. And if workers are, furloughed, they tend to come back and get full pay. So again, investors largely look through it. The second catalyst that was the primary catalyst for the stock market advancing in the month of October is the fact that we entered third quarter earnings season, and earnings season is very strong once again. So the graph that we're showing here is a table that shows expected earnings growth for the third quarter, the full year of 2025, and then next year 2026. And again, very broad, strong gains. So just want to highlight a few things that we've seen so far from earnings season. And again, it's early in earnings season, but we expect these trends to continue throughout earnings season. So first of all, the growth rate is double digit levels for the fourth consecutive quarter at just over 10%. And we see other non-technology sectors, things like financials and industrials, also participating with technology. The rate at which companies are beating expectations is very high and well above historical averages. The amount by which they're exceeding expectations is also very high, both for revenues and for earnings. Lastly, earnings expectations for this year and next have risen in recent months, and that's sort of a trend change from what we normally see during earnings season. Generally, we see the next year earnings expectations sort of go down as we anticipate that period. But this time, expectations for 2026 are holding steady, and expectations the last few months for 2025 have actually risen. So we actually feel pretty good about earnings expectations, not only for this year, but also going into 2026, with the major tailwind being, the spending that we're seeing around language models, artificial intelligence, data centers, the demand for power and electricity. And again, we expect that trend to continue into 2026 and further propel the stock market.
There was another Fed meeting in October where the Fed cut rates for the second consecutive month after an 8-month pause. Dan, what were our takeaways from that meeting?
So just to recap the meeting, we saw another quarter point cut in October, and that follows a quarter point cut in September. So now for this full cutting cycle that the Fed embarked on back in September of 2024, we've seen 1.5 percentage cuts to the Fed funds interest rates. And we still think further cuts are in store. So the main takeaway from the meeting in October is the fact that during the press conference, Jerome Powell kind of talked down investor expectations for another quarter point cut at the next meeting in December. We still think another rate cut is in store, mainly because I think he was referring to the lack of economic data that the Fed has to analyze during this government shutdown. But we fully expect the government to open soon and them to have more data to analyze. And then as we think about Fed rate cuts into 2026, we still think 2 to 3 are appropriate. I would refer our readers and listeners back to the graph that we showed last month, where we showed the path of future rate cuts for last quarter of 2025 and then into 2026, with Fed funds interest rates settling out at about 3.25 to 3.5%. We still think that's right and appropriate. And again, we would expect another Fed interest rate cut at the December meeting.
With all that in mind, what is our outlook for the financial markets?
The outlook is still constructive. Even though we've had solid gains so far this year, we still think further gains are in store for this year and next. We already talked about the trends for earnings growth remaining strong. Investors are underestimating earnings for many quarters now. We think that's going to continue with companies surpassing earnings expectations and also issuing strong guidance. And we think the tailwinds of monetary policy and fiscal policy are in store for next year. So monetary policy referring to the fact that we expect further interest rate cuts, and then fiscal policy from the budget bill that was passed in July. We think a lot of those business expensing tailwinds are going to kick in early 2026. So again, we've got some pretty solid foundations with monetary policy, fiscal policy, and earnings growth that we think will further propel the stock market going forward.
Very good. Thank you for sharing your insights, Dan. And thank you for watching. As always, we appreciate your continued trust and support.